Maybe I misheard. Just taking a step back, Carolyn asked several of us to form a subcommittee, and one of the early questions was the use of the vehicles at the underlying securities in the portfolio.
Right over to our single item agenda item. I'm going to turn that right over to Tom Collmore. At the risk, guys, I'm a little tired here as it's midnight here in London, and so at the risk of misspeaking, I'm just going to turn it right over to Tom, who's going to take it from here and discuss the findings here from the subcommittee.
Thanks, Carol. Happy to step in. Gabrielle, did you confirm we have a quorum of 5 and 3?
We do.
Okay, sorry. You probably said that. I've already forgotten.
Nope,
So thanks, Carolyn, for that. Just taking a step back, and I have no excuse for being in London. I'm just tired in general. So taking a step back, Carolyn, I hear some background talking. Somebody talking? Maybe I misheard. Just taking a step back, Carolyn asked several of us to form a subcommittee, and one of the early questions was the use of the vehicles at the underlying securities in the portfolios are moved into with the transition from Vanguard to BlackRock. And BlackRock has sent around materials discussing ETFs and CTFs and mutual funds, comparing and contrasting. So, and the members of the subcommittee, or Carolyn might correct me if I get any of this wrong, but just to summarize, BlackRock has moved us into CTS, which are collective trust funds. These are regulated products. They're akin to open-end mutual funds. And for internal liquidity in ETFs, and the OPED is in ETFs, which are more akin to a closed-end mutual fund. Both are regulated products. Both are very inexpensively run. And the difference is that CTFs in cost are minimal between CTFs and ETFs. So just to cut to the chase, the subcommittee considered where we are, and the consensus was that given the very, very low cost difference between the two products, for internal liquidity, it might be nice to have 25% of the town's pension in ETFs. So 75% would remain in CTFs and 25% would move to ETFs. Again, for just internal liquidity. Some people were more concerned than others with the liquidity issue. I think those of us who were less concerned took a lot of comfort from the fact that the difference in pricing is extremely low. I think I did a quick back of the envelope, and we're talking very differences, and those differences should be swamped by, of course, expected performance. So I'm going to pause there and just see if Carolyn or any of the members of the subcommittee want to correct or comment. But that's where we are, and the next step would be to take a vote on making that small change, a minority change in the vehicles we're using for the performance. I'll pause there.
Sorry, wanted.
Would any of the other members of the subcommittee want to weigh in?
We have a hand from First Selectman Gerber.
But I wasn't on the subcommittee.
That's okay. Go ahead.
Well, that was the next step.
I think you are allowed a comment.
Okay. I don't think I saw the I may have missed the comparison document. I just want to be clear.
Sorry, wanted.
The CTF, like if it's 105 in the afternoon, we put a trade in. Is the pricing we get at 105 in the afternoon, or is it 2 days later, or whatever? When do they price the sale? Is it sort of like more like a mutual fund, or do you get is it the pricing and when you place the trade?
Yeah, this is Nick Leeper. I want to step in and correct one thing. Tom said that sorry, wanted. It's similar to a closed-end mutual fund. That's not quite correct. ETFs, through the creation and redemption process, they can create shares into perpetuity, and there's a process with market makers and a whole mechanism to keep arbitrage and premiums and discounts at a minimum. So I just wanted to step in and clarify that. And then Bill, to answer your question, that's one of the big differences here. So if you have an ETF, there is a market right now for that product, or when the market's open. So you can go ahead and lock in your price right now. If you have a mutual fund and you want to liquidate, then or trade, then you place your order now, and then that goes in at the end of the day at now period. And that then with the collective trust, if you want to trade, there is a notice period, and the notice period changes by product. But for something like a a passive U.S. Equity product, if you wanted to trade, you would have to send notification today that you were going to trade, and then it would trade. Likely that's like a 24-hour notification period, and that would trade tomorrow, and then you get tomorrow pricing.
Tomorrow,
So even a little bit, yeah, like tomorrow. Do we know if it's at the close, Tom?
That's my understanding, and
Yeah.
I want to admit that I was simplifying I didn't get into the creation and destruction of ETFs angle. That's to minimize arbitrage potentials, but I totally agree with Nick, what you said earlier. I just thought that was a level of complexity that we didn't get to, but you're right. And as far as your second point goes, I believe it is the end of the day pricing, yes.
Okay.
So I want to echo what Nick said, that there is another difference between CTFs and the ETFs are not completely similar to closed-end mutual fund. There is a creation and destruction process that's supposed to minimize the opportunity for arbitrage. I just thought that was perhaps beyond the scope of the call.
but
The committee also discussed the fact that ETFs are not a perfectly efficient vehicle either, right? So if you're trading an international ETF, international markets are closed, the ETF price does not exactly match the price of the basket of stocks at the time of trade. So there were some inefficiencies in ETFs themselves, or in this instance, the iShares product. So we did discuss that too. There's no perfect efficiency in either vehicle.
Right.
But that's how we came to this consensus that if we needed to liquidate something, and obviously not for a tactical decision, but because we needed just to raise cash in an emergency, we would have this vehicle opportunity of the ETF to liquidate the cash and be able to do that in a period of time, which would create a little bit more efficiency than the other product.
yeah, like, I mean, 2008, massive swings. And if you waited a day or two for pricing, you could have gotten killed,
So, Bill, the likelihood of needing to liquidate positions in the event of an emergency is very low.
Yeah.
Right. I mean, that's just simply not the way that the funds, that the trusts operate.
Got it.
However, it's our responsibility to also be managing across all different risk frontiers, liquidity being one of them. And so this is an opportunity for us to explore the ins and outs of the CTF, while not going full into the CTF, right? And let's, I think this was a nice consensus approach, to withhold some of it and keep part back in the ETFs. Just from the liquidity perspective, to me, this was a very sound approach.
Yeah, one thing to add is if there is a significant drawdown in the marketplace, that's 2008, right? Chances are you're not looking at the entire portfolio. It might be tactical. So if you're not putting everything in cash all of a sudden, because you're going to have a day or two later, you're going to have another upswing. So while we have that piece of liquidity, 25%, most of the stuff isn't going to be traded. And we plan out stuff. You have so many retirees each month, and we plan out when what gets sold at our meetings or stagger them out. So it makes sense to have not liquidity, liquidity part as well as the other part. So
If I could just comment, I think I heard what Eric said. I'm not positive, though I did, but the only reservation I had about this entire discussion was, and I think everybody's heard me maybe once too often, but I would worry a little bit about the desire for liquidity. I agree with what Carolyn said. it's a just in case and it's a cheap just in case. But I do worry that some people might mishear this as, oh, we can jump in and out of opportunities because we now have more liquidity. And I think everybody on the subcommittee, and Carolyn and Barclay Douglas, our advisor for that matter, all agree that that's not what we're talking about here. We're not talking about jumping in and out of quote unquote opportunities, on a short-term basis. We're long-term investors and need to act that way.
Yeah, in fact, I would probably say that this is the alternative to having a large cash position, right? So we don't typically have capital in cash. It's fully invested all the time. So this is that insurance policy, so prevent that.
Carol, does it make sense to turn it back to you and just proceed to the vote if there are no other comments or questions?
Well, so I would like to just ask if anyone has any questions or would like further explanation before we do, and then I would like to take it to a vote. Bear in mind, guys, this represents the kind of the more liquid pieces of the portfolio. So this is not the private equity allocations. This isn't that real estate allocation. This is for the public equity, and it's also for the fixed income too. Or is this just the public equities?
Fixed income as well.
It's for both the public equity and the fixed incomes.
And it's only for the town.
And it's only for the town. Okay, so we know kind of what we're talking about, which bucket of funds. And I know it feels a little nuanced, and it's a relatively new vehicle for us on the JRIB, and I'm really grateful to the subcommittee for spending the time with it to understand it. But if anyone has additional questions, this would be a good time.
Okay, do you know when were these vehicles, like when was this vehicle created? How long have they been around?
I wish we had, Bill, I wish you had the document that BlackRock sent. It's entirely possible that you were omitted. I don't know. It's unfortunate.
I
So
may have just missed it. Yeah.
I think it was, if memory serves, it was before, I think it was around the 1990s. Anybody want to correct me on that one?
No, I was going to say the CTF has been a vehicle that's been around for 30 plus years. BlackRock is not the only one offering that product. So, and it's something that's only available to public pensions as well. So that's why the OPEB isn't in the product. There's only a certain type of institutional investor that can be in these products.
That's right.
Okay. Thank you.
Yep.
Okay, not hearing any additional questions. We're ready to take a vote. Would someone like to make a motion?
I'll make a motion to vote.
Okay.
Second.
Okay. All in favor, please say aye.
Aye.
Okay.
Aye.
Okay. Probably easier on WebEx. Are there any no's? Okay. Are there any abstain? Okay. Hearing that, the motion carries unanimously. Terrific. We'll notify BlackRock of the decision tomorrow. Tom, would you want to do that? You want me to do that? I'm on a plane tomorrow. We can coordinate that.
I can write an email, copy you, Carolyn, if that makes sense, if that's easier for you to respond that way. Your
Terrific.
call.
Thank you.
No
Okay.
problem at all.
Okay. Guys, with that, the next item is just to adjourn. May I have a motion to adjourn?
Motion to adjourn.
All right, a second? That's all right. Terrific.
I second.
Guys, thank you very much. We've adjourned at 7:22 p.m.
Whatever it is, right?
Whatever time it is.
Thank you.
Good night, guys. Thank you very much.
Good night.
Take care.
Good night.
Bye.
Bye.